On August 15, 1971, a Sunday evening television broadcast severed the last structural tether between the United States dollar and physical gold. President Nixon announced the temporary closure of the gold window, a decision that was never reversed. What followed was not merely a policy shift, but the activation of a mechanism that had been building pressure for decades. The Bretton Woods system, designed in 1944 to anchor global currencies to the dollar and the dollar to gold at $35 per ounce, had become unsustainable not because of external shock, but because of internal contradiction. The structure required fiscal discipline that conflicted directly with the political incentives of deficit spending. When French officials began demanding physical gold in exchange for accumulated dollars in the late 1960s, they were not being antagonistic. They were simply testing whether the system's promises matched its reserves. The answer was no. The reserves could not cover the claims. The mechanism failed not from sabotage, but from arithmetic. This was not the first time such a pattern emerged. In 1797, the Bank of England suspended convertibility of its notes into gold during the Napoleonic Wars. What was presented as a temporary wartime measure persisted for 24 years. The suspension allowed the government to finance military operations without immediate fiscal constraint, but it also created a precedent that the anchor could be removed when politically convenient. By the time convertibility was restored in 1821, the currency had already absorbed years of depreciation, and the economic structure had adapted to a system where promises replaced metal. The pattern repeated in 1914 when European powers suspended gold convertibility to finance World War I. Again, the suspension was framed as temporary. Again, it persisted long after the conflict ended. The interwar period saw attempts to reconstruct a gold standard, but these efforts were built on compromised foundations. The gold exchange standard of the 1920s allowed central banks to hold foreign currencies as reserves rather than physical gold, diluting the discipline the original system imposed. When the Great Depression struck, countries abandoned this hybrid structure one by one, each choosing currency depreciation over domestic deflation. The sequence was not random. It followed the logic of least political resistance. What emerged after 1971 was a system with no external anchor. Central banks could expand money supplies without the immediate constraint of redemption. Government debt could grow without the discipline of metal backing. The initial consequences seemed manageable. Inflation rose during the 1970s, but it was eventually suppressed through aggressive interest rate policy in the early 1980s. What was less visible was the structural transformation occurring beneath the surface. Debt began accumulating at rates that would have been impossible under a convertible system. Financial markets grew larger and more complex, increasingly dependent on central bank liquidity provision. The ratio of financial claims to underlying real assets expanded steadily, creating a structure where confidence became more important than solvency. This was not accidental. It was the logical endpoint of a system designed to prioritize flexibility over restraint. The mechanism operates through stages that repeat across different eras and institutions. First, a crisis or political pressure creates demand for expanded government action. Second, fiscal limits become obstacles to that action. Third, the monetary system is adjusted to remove or weaken those limits. Fourth, the adjustment is presented as temporary or technical rather than fundamental. Fifth, the temporary measure becomes permanent because reversing it would require accepting pain that political systems are designed to avoid. Sixth, the expanded system functions without immediate crisis, creating the impression that the old constraints were unnecessary. Seventh, new imbalances build within the expanded system, setting the stage for the next crisis. The cycle does not repeat identically, but the underlying structure remains consistent. Each iteration leaves the system more dependent on managed confidence and less able to tolerate disruption. Historical data supports this pattern with uncomfortable precision. In 1913, total U.S. federal debt stood at approximately $2.9 billion. By 1945, after financing 2 world wars and a depression, it had risen to $258 billion. By 1971, when the gold window closed, it had reached $398 billion. By 2008, on the eve of the financial crisis, it exceeded $10 trillion. As of late 2024, it approaches $36 trillion. The acceleration is not linear. It follows an exponential curve that becomes steeper after each crisis intervention. The pattern is visible in other advanced economies as well. Japan's government debt to GDP ratio exceeded 260% by 2024, a level that would have been considered impossible under a gold-backed system. European nations collectively carry debt loads that require sustained central bank support to remain serviceable. The common thread is that all these systems severed their anchors decades ago and have been managing confidence ever since. The modern structure reveals itself most clearly in the behavior of long-term interest rates. Under a truly market-determined system, rates would rise substantially when debt levels and inflation risks increase. Instead, rates have been suppressed through direct central bank intervention, forward guidance, and quantitative easing programs that purchase government bonds in quantities large enough to dominate price discovery. This is not conspiracy. It is documented policy implemented openly by institutions including the Federal Reserve, the European Central Bank, and the Bank of Japan. The stated justification is economic stabilization. The structural effect is to remove market discipline from sovereign borrowing. When central banks become the largest buyers of government debt, the traditional feedback mechanism between fiscal excess and borrowing costs breaks down. Governments can run larger deficits without facing immediate market punishment. The cost is deferred rather than eliminated. This deferral creates a secondary mechanism that operates through currency depreciation. When a central bank expands its balance sheet to purchase government bonds, it creates new monetary reserves. These reserves do not disappear. They flow through the banking system and eventually into broader money supply measures. The expansion may not produce immediate consumer price inflation if velocity is low or if the money remains concentrated in financial assets, but it does produce a gradual erosion of purchasing power that becomes visible over years rather than months. The clearest evidence appears not in official inflation statistics, but in asset prices. Real estate, equities, and commodities all show sustained appreciation that outpaces wage growth, creating a wealth effect for asset holders and a purchasing power decline for those dependent on fixed incomes or savings. This is not a bug in the system. It is a feature. The expansion transfers value from creditors to debtors, from savers to borrowers, and from future obligations to present consumption. Gold's behavior within this structure is not mystical. It is mechanical. When the rate of currency creation accelerates and when real interest rates turn negative after adjusting for inflation, the opportunity cost of holding non-yielding assets declines. Simultaneously, the risk of holding currency-denominated claims increases. Gold serves as a measure of confidence in the monetary system itself. Its price does not respond to quarterly earnings or economic growth rates. It responds to the gap between the quantity of monetary claims and the trust that those claims will retain purchasing power. In 1980, gold briefly reached $850 per ounce as inflation expectations peaked. Adjusted for official inflation measures, that would equal approximately $3,200 in 2024 terms. Current prices remain below that inflation-adjusted peak, suggesting that either inflation measures understate actual currency depreciation or that gold is still repricing relative to the expanded monetary base. Central banks themselves provide evidence through their accumulation patterns. According to World Gold Council data, central banks have been net buyers of gold consistently since 2010, with purchases accelerating in recent years. These are not speculative traders. These are institutions managing reserves across decades and centuries. Their behavior suggests they understand the structural limits of a purely fiat system, even as their public communications emphasize confidence in existing arrangements. Silver operates within a dual framework that combines monetary characteristics with industrial necessity. Approximately half of annual silver demand comes from industrial applications, including solar panels, electronics, medical equipment, and electrical contacts. This demand is relatively inelastic in the short term because silver's conductive properties make it difficult to substitute in precision applications. The other half comes from investment and monetary demand that responds to the same confidence mechanisms that drive gold. This dual nature creates volatility but also creates a floor beneath price corrections. When industrial demand weakens during economic slowdowns, investment demand often strengthens as concerns about currency stability increase. The result is a metal that can outperform gold during phases of simultaneous industrial expansion and monetary concern. Supply constraints amplify this dynamic. Primary silver mine production has remained essentially flat for over a decade despite rising prices, indicating that new supply does not respond quickly to price signals. Most silver comes as a byproduct of copper, lead, and zinc mining, meaning silver production depends on the economics of other metals rather than silver itself. The pattern suggests a system approaching a decision point rather than a stable equilibrium. Government debt servicing costs are rising toward levels that will soon exceed defense spending in multiple advanced economies. Central banks face a choice between allowing interest rates to rise and destabilize debt markets or suppressing rates and risking currency confidence. Both options carry consequences that policymakers spent decades avoiding. The historical record indicates that when forced to choose, authorities consistently prioritize short-term stability over long-term soundness. They choose inflation over default, currency depreciation over political crisis, and deferred consequences over immediate pain. This is not moral failure, it is institutional logic operating exactly as designed. The question is not whether this pattern will continue, but how long the continuation remains possible before the gap between claims and resources becomes too wide to manage through confidence alone. Reform remains theoretically possible but structurally improbable without a crisis severe enough to overcome entrenched incentives. Until that threshold is reached, the mechanism continues grinding forward, accumulating pressure in forms most observers will not recognize until the release becomes unavoidable.